Hello, everyone. Welcome to the market update here for Tuesday, January the 31st, final day of January. If you have any questions during the week or any questions I don't get to here in the live class or as you're going through the recording, make sure you send those to Jerry at TradersPro.com. I haven't had any questions for a few days, so there's definitely, if you've got questions, I've got some time to answer them. So. Also, I double check every time now to make sure that the audio is okay. If you're hearing any sort of a clicking noise or any noise that's distracting, let me know, and I can dial back in. It's important that you let me know if it's there, because I can't hear it on my end, and then it gets, not only would it be annoying for you to listen to it during the whole class, but it gets on the recording as well. And so if you do hear that, make sure you let me know, and I can, like I said, I can dial back in, and usually that solves the problem. We haven't been able to figure out what's causing that. All right, let's get started. Obviously, a big week this week. Starting tomorrow, well, actually, kind of maybe starting after the market closes. I know Snap has their earnings coming out. Not that Snap is going to have a major movement on the market, but it is Meta reports tomorrow, so maybe it gives a little bit of an idea of what Meta's numbers may look like when they report. But the big day is going to be Wednesday. Obviously, there's the Fed meeting Wednesday. And so about this time, actually right at this time, tomorrow will be the Fed announcement. And that's going to be a market moving event. There wasn't a Fed meeting in January. And so this will be the first Fed meeting of the new year. All the focus is going to be on that. Now, as technical traders, we're not too caught up with the fundamental things that are going on, some of the noise that's going on out there. But it is important to be aware of these events because they do move the market, and they can be kind of binary events where market's either going to go up or down based on how it feels when those events take place. If the market feels more bullish or more bearish. And so you at least want to be aware that they're there, so you don't get caught off guard with big moves that could end up taking place. And then after the market closes tomorrow, on Wednesday, you've got Meta's earnings, like I said, and then Thursday you've got Amazon, Apple, and Google all reporting after the market closes, and then that's going to be a big event. And then Friday morning you have the jobs report, and not all jobs reports are that important for the market as far as the market making a big reaction to it. But this is something the Fed is watching very closely. It is factoring into their decision what they're doing. Although I've got to assume the Fed already knows what that data is. I don't know I don't know how that works, and who knows ahead of time what the numbers are, but I would assume that they have some inclination of what that jobs report's going to show, and so we might get a little bit of a hint of that on Wednesday in whether they're a little bit more hawkish or dovish. I just can't see the Fed being dovish at this point. Especially what we've seen since the beginning of the year. It's been incredible where we've seen. Let me give you an example just real quick. Look at Carvana. Carvana, I don't know if you've know much about this company. They're this car selling company. They have these big buildings that they call them car vending machines. They're these circular buildings. They have all these cars in them, and you can see them. We have one by the freeway here, so I used to see it every day driving by. Well, they just been burning through money, and it was a $200 stock, and it came all the way down to $2 or something like that. I mean, they're going bankrupt. In fact, the last time I noticed driving by the freeway, there was only one car in this Carvana building, and it was at the very top. And I'm like, yeah, this thing's going under. Look what this thing has done. It was a $2 stock, and since the beginning of January, it's gone up to about $10 or something. It's like quadrupled in size in a month. Why? It's a short squeeze. People are short the stock and believing it's going out of business, and there are people out there trying to squeeze those shorts to get them to buy to close out their positions. But I've seen a lot of this lately. Another one that's a car company. I used to trade this with options back in the crazy the crazy period right after COVID, when all the money was the market was being flooded with cash, with money. People were buying stocks. People didn't know anything about the market were buying stocks, but this one was a workhorse. Another one that's probably on its way out, went all the way down to a dollar stock. Look at that move in January right there. I mean, it doesn't make a lot of sense that people are speculating. Now, speculation, by the way, the reason why these trades worked back in 2020 is because when the Fed is pouring money into the market, and they lower interest rates down to nothing, then that is when you want to invest in these companies. These companies take off. These companies aren't making money, but they have that potential, quote unquote, to grow. That's when you see a lot of the speculation that ends up working. But remember, the Fed is tightening, and so these companies rally with the Fed tightening doesn't make a lot of sense. And I'd be very careful if you've been chasing some of these. If you're doing day trades or short-term trades on them, okay, that's fine. Take advantage of the move they're making here in the short term, but be very careful with some of these, because this is not the environment for those companies to do well. And I'd hate for it. And the problem is that if you don't know what you're doing, you think immediately back to 2020. You're like, oh, these stocks are taking off again. I made so much money with these stocks. You start looking at the SPACs again. Man, maybe they're going to take off too. And you're jumping into the trash that's out there, and you're going to probably get killed a second time if you didn't already get killed when it rolled over a year or so ago when the Fed started tightening. You're probably going to get destroyed again on it if you're chasing that. Now, if this market is in a legitimate rally off the bottoms, if we have hit the bottoms for the year or for the decline, then there's higher quality companies you could start to get involved with that would make a lot more sense. Companies that are making money and actually, doing well. Now, if you missed the Thursday class last week, I did talk a little bit about just comparing this trend, the market chart that we're seeing right now over the last year or so, a little over a year now, to the decline back in 2000 to 2002. That was the internet bubble burst. I'm not going to get into the details of that because I spent a lot of time on that on Thursday. But I'd encourage you to go through the recording of that. And that's something I'm keeping an eye on here. I'm not saying it's going to play out the same way. Markets don't play out the exact same way as they do in the past. There's different circumstances now than what the market was dealing with back then. But it was a reminder of, this whole thing I've been really focused on about this panic sell-off we haven't had. I haven't experienced a major market bottom without one. And even beyond when I've been trading, you go back and every major market bottom has had one. So to not have one now would be the lower probability outcome. Now, you can always have lower probability outcomes. That's why the market works, is because occasionally it will do things that it's not supposed to do, and it throws everybody off because everyone's like, hey, this is what it always does. So I'm open to that. But one thing I did talk about on Thursday is if you get if you really start focusing on lower probability events taking place, you're going to have a tough time in your trading, because I'd rather expect the higher probability events take place and be wrong than start embracing a whole bunch of lower probability events, because everything's possible, and not very many things are probable, and you start to really get yourself into trouble if you start embracing low probability events. So the reason why I focused on that period that 2000 to 2002 was that was a time when it looked like the market was recovering, and then it rolled over, and it gave us that panic sell-off at the summer of 2002, and that's when the bottom kind of established. Now, one thing you could also look at in that time period as well is it took a couple more years to establish that bottom. The market rallied and then came back down and retested those lows again. It took a lot of consolidation to squeeze out all the excess that took place in the late 1999, 2000, the internet bubble. It took a lot of time to kind of to squeeze that money out of the market. And so, if your expectations are this market is going to start flying again, especially like it did at the COVID lows through last year when it topped out, it's usually it takes time to change the market behavior, and so I would expect a lot more back and forth. Even if the market has bottomed out, I would expect a lot more back and forth, before it starts taking off again. I just don't see the Fed. They may stop raising rates at some point, but they're going to probably keep these rates pretty high for a while, and that's going to be put pressure on these small companies that borrow money to get started. That we traded a lot during the COVID bottom heyday. They're not going to be able to survive in this environment, or be able to really grow quickly in this environment. So just you want to make sure you're not I just want to temper everyone's expectation. The market is not likely to just start taking off again. And if it does, again, that's exactly what Chairman Powell doesn't want to see. It could lead to more rate hikes and more, more pain that way. So anyway, direction alerts here. That we are creeping up towards the overbought, but we're not there yet. Momentum is in the buy range, and it's still, even when it gets to the extreme range, it's usually the right side of that extreme range that we start to worry about the market getting extremely overbought. We're definitely not there yet. So if the market does want to continue to rally, there's room to run as far as these indicators are concerned. Now, for those of you that are new, these indicators are telling us how far the market is stretched. Is it gone up too far, too fast to where it's overbought? Is that rubber band stretched to the buy side? Or is it gone down too far, too fast, and it's oversold? Has it been stretched to the sell side? So the biggest thing we're paying attention to with these indicators are these extreme boxes. If it gets into this extreme, it's gone down too far, too fast, that it's probably. Now, by the way, it doesn't mean it has to reverse trend. If you've gone down, it doesn't necessarily mean that you have to go up when you get in this extreme oversold condition. It could be that you move sideways. A sideways move would alleviate that, and it could mean that downtrend does continue, and then that pushes you back into that extreme range again. So this is just telling us, is the market stretched? How can this help me? Well, if the market's taken off, and we start to get on the right side of this extreme reversal risk, it's telling us the market has gone up too far, too fast. It's stretched to the upside. You're probably going to see it pull back or move sideways to consolidate that move, meaning it's either going to pull back in kind of this ABC pattern or move sideways. Again, it can just move sideways to alleviate that overbought condition. It gets back into this buy range again, and then it can start to take off again. So that's all we're really using these indicators for, is to see if it's stretched. Because obviously, if the market's gone up, you're in the extreme reversal risk. I don't want to buy in to the trend. I usually want to avoid buying into the trend in that area. I'm not saying you can't, but you're buying into a stretched trend. The probabilities are starting to increase that you're going to get that correction or that pullback. Not that it will. I've seen stock markets and stocks stay overbought for a while. They can stay in that extreme range for a while, but again, from a probability standpoint, you don't want to get in the habit of entering trades in that extreme environment, because again, just from a probability standpoint, it's probably more likely to pull back. What you're better off doing is just being patient, wait for that pullback, and then have that alleviate that overbought condition and get in somewhere in here on the pullback, on the step within that trend, and then ride the next move higher. Or if it's a sharp move down and really starts to fall, but it could be a trend reversal, and you'd want to avoid it altogether if it's going to be a much bigger correction that takes place. So that's where this stuff helps us a little bit. Brett, again, we're still kind of in the middle on this one, just barely moving into the high range. So that's not extreme. Now the sentiment's been extreme for a while. This has been on the far right side for quite a while now. This is also what concerns me about the market conditions. It's hard for me to expect the market to rally significantly when the sentiment is too high, complacency is too high. Not that it can't happen, and it has rallied this month with extreme complacency. It's been to the far right side this whole month. But it's just it's getting to a point where it's getting a little bit dangerous with the market not just thinking that everything's fine. That's when it tends to get shocked and get not positioned properly for a decline. These professional traders stop buying those protected puts, thinking they don't need to spend the money on them anymore, and then the market drops and they realize they need them. They got to chase them at that point, and that's when that VIX indicator starts spiking up. Buy-sell ratios, they're wide, but they're not. They could get a little bit wider. You can see that these ranges are about the same as some of these past ones where it started to come closer together. But we've also seen a few where they've been stretched a little bit further. But that's a little bit wide. Now that could change again with what happens this week. But this is something that there again, this is where I wouldn't be surprised. I'd be actually expect that the market would correct a little bit off of all the news that's coming out this week, just because it's run up so far in January ahead of all this stuff coming out. I think people have already traded the expectation, traded what they're expecting the Fed to say and what these earnings to say. Again, things are getting a little bit stretched. Could it still go higher after that? Yeah, it could. But then, we saw this happen back in November when in early December, I think it was early December. That was right at the end of November where we had a Fed meeting. We had a CPI report that came out, and the market jumped up off of that. And then, so I had a bullish move off of the news, and then immediately started selling off right after that. I think we could see possibly maybe not sell off as much as it did back then, but wouldn't be surprised to see a little bit of a consolidation or pullback from this condition here. This sentiment indicator is getting a little high as well. Again, if we pushed higher this week, you'd probably bump into that extreme range, and you'd be kind of set up to maybe start pulling back or selling off a little bit next week. So we'll keep that in mind as well. Now let's take a look at the charts. Now, what I was looking at obviously we've broken that downtrend line that we focused on for a while now. We recently broke through it. We actually came back and retested that line, pulled back to it, and now we're going to see if it can break out. Now, the next area we want to look at is this area right here. This is going to be very important. It's right around 410. The reason why this is important is during this decline, we've had lower highs and lower lows. This was the last well, actually there's two areas. This is actually probably a more important high right here to break above. This was the previous lower high before the last lower low. So the lower low happened in October. That's what everyone's focused on, those October lows. This put in a little bit of a lower high, and what we're looking at right here, what we're looking at the 410 area right here is if we put in what looks like a higher low right here. If we break above 410, that would be a higher high. The market would be acting like an uptrend at that point. It could also be just a large bearish ABC pattern that leads to a bigger decline. I kind of outlined that on Thursday. That maybe we could, although that we'd probably rally up a little bit higher than that. But I outlined that as a possibility that could bring in that could alleviate a little bit of the bearishness in the market, cause the market to get too overconfident, and then you get that wave C, and that's what can create the panic selling, is when people aren't expecting it. This, though, is also a critical area. So if we can break out above this high at 410, we'd want to look at this high back here is the next area. And all we're doing is we're looking ahead and we're saying, okay, as we break above these levels, it's just adding more confirmation into the trend reversal. We can't know for sure if we're in an uptrend or a downtrend, or we've gone from an uptrend to a downtrend or a downtrend to an uptrend. All we can do is, as technical traders, is see, okay, is it behaving like an uptrend? Is it now suddenly behaving like a downtrend? And so far, until I was holding off, I was expecting the market to continue to move down. That's why I was so bearish right here in December, because every time we hit this trend line, we've dropped. That's the trend direction. It's acting like a downtrend. So while it's still acting like a downtrend, you assume the downtrend is going to keep going down. Where I got thrown for a loop was when the market made a lower probability move. Typically, when you have an impulsive move down and then a corrective move, you hear me say this all the time. Whenever you see the market moving side or a stock moving sideways, you want to pay attention to the direction it's moving before it moves sideways. That's where it's more likely to go after it's done moving sideways. Typically, it will. Typically, it should have another move down. And the market came back up instead. We were still looking at that trend line, though, because sometimes it could be the market's just trying to hold on, trying to rally. But then as it failed on this drop right here, and now you're breaking through that trend line. First time during the whole last year that we broke through the trend line. Not only that, you've got now a higher low right here, breaking out, you had a higher high. This is acting like an uptrend through here. And now if we can break out above this 410 area, you've got a larger pattern that's acting like an uptrend. And you don't want to fight that, okay? That's a behavior. And so in other words, people ask me all the time, am I bullish or am I bearish? And I hate that question because I don't want to identify myself as bullish or bearish. I want to be neutral. I just want to get the direction right. And so when I look at these things, and I like I said, I spent a class talking about 2000 to 2003. It's not that I'm trying to continue to find reasons for the market to go down. Like I said, there's a lot of conflicting signals that I'm seeing out there. And with those conflicting signals, you got to be prepared either way. I don't want to get sucked into a suckers rally and then have a panic sell-off that takes place, and I'm caught off guard and I'm overexposed to that. I would like to see the more of these targets that start breaking above, the more things that confirm the uptrend, the stronger, the more bullish I'll become on the trend. I do this on the way down as well. It takes me a while when we topped out last December, it took me a while to really believe the market was reversing into a downtrend. It had to break through these uptrend levels that we were in. And I guess we could see maybe a few months. I go to a 2-year chart. So, we had this uptrend line. Until that point, we had higher highs and higher lows, and then we had a lower high right here, and then we ended up breaking to a lower low down to here. It took me when we broke that trend line and we were selling off pretty sharply through here, I knew that there was a good chance that the market was reversing. Markets always fall a lot faster than they rise. So when you get these really sharp moves down that break trend and an uptrend, you usually know you're in a trend reversal at that point. But what confirms it is when you rally back up and then you have a lower high, lower lows. It starts acting more like that downtrend. The more it keeps doing that, the more it confirms that trend. So, so the bottom line is that what I always say, and again, this is geared more towards the newer people that need to get used to me a little bit. I liken this whole process as being like a defensive coordinator on a football team or something, trying to prepare for a football game. I don't know what the other team is going to run specifically, but I might be able to get an edge by saying, okay, when they line up this way, they're usually going to run the ball, or when they line up this way, they're usually going to pass the ball. I can look at these different scenarios and be ready to react to those different scenarios. And hopefully I've done enough work to really recognize the little clues they might give me that, maybe if it's a pass play, the offensive linemen don't dig in as much. They're back on their heels a little bit because they're usually going to come back when they're pass protect instead of drive forward when they're run blocking. There's little clues that you can pick up on that might give you that edge. That's kind of that's how I liken this process in the markets here. I like to look at the bullish reasons why the market can go up, and I also look at reasons why the market could go down, or what could prevent the market from bottoming right here. Mostly just so I'm prepared either way, and I can react. And so right now. Now, yesterday kind of threw me a little bit because we had a bearish reversal candle yesterday, closed below the low of the previous day. Now, we did that back here, and it led to a lower movement, and it reversed right away. So some of these bearish reversal candles recently, there was a bearish reversal candle. Boy, in almost every situation, you have a decline like that, a consolidation, and then you get a bearish reversal candle like that. I would say about 8 or 9 times out of 10, you're going to get some move down. Maybe not a huge move down, but I would have expected at the very least we would have moved down to the lower part of this range here. It shook it off. Bearish reversal candle started to move down a little bit, shook it off. Bearish reversal candle yesterday. Today, there's still a little bit of time in the trading day, but it looks like it's might be shaking it off again. So, we'll see. But that behavior there is acting like an uptrend, right? Every time the sellers are showing that they're gaining a little bit of strength, the buyers push it right back. Okay, that's bullish behavior that's taking place right here. Now, how long that lasts, I can't know, but that's why I'm kind of watching this area though to see can it break above here, because we're seeing some bullish behavior here, but can it break to a new high right here? That'll be the next obstacle, and especially this week, because we got all these events. These events are going to push us above this area, or they're going to, maybe we move back down and test these lows again, and we stay in a sideways range for a little while. We'll see. Now, I'm not going to spend too much time on, if we look at the Dow is starting to lag a little bit compared to the S&P and the NASDAQ. And so we talked about this a few weeks ago where, we had pointed out that off of those October lows, the Dow had made this huge move up. It had taken out this previous high right here. This was clearly an impulsive move, not a corrective move, where especially the NASDAQ looked corrective as it tried to rally. It barely rallied higher off those October lows, and still doesn't look the same as the Dow. But what seems to be happening right now, especially when you see these Carvanas and Workhorse and BlackBerry and these Robinhood, these companies they're not making any money. Laser, LAZR, that money has to be coming from somewhere, and I think what's happening right now is that some of the money is coming out of those Dow stocks, and they're some of that. I don't know. I wouldn't call that smart money that's going into these companies. I think it's a lot of retail traders that are, kind of that Reddit crowd that are just looking for short squeezes. But we're noticing how there's a little bit lower highs now that are kind of establishing on the Dow. It looks like some money is coming out of those Dow stocks and it's going elsewhere. It could just mean that it's just a little bit of a rotation to let, into tech, maybe to let tech catch up a little bit. But if you compare that to the Dow, what's happened to the Dow to the NASDAQ 100, you can see that, first of all, you can see what I was talking about as far as lagging. The Dow was all the way up here off of those October lows. The NASDAQ was really lagging. The NASDAQ almost retested those lows back here on that December sell-off. And now that's kind of outperforming a little bit. Same thing. It's about to break above it. Well, technically it did kind of break above this high right here. It's kind of pulled back a little bit. But is that, now, again, the question here is, okay, the Dow is leading and now the NASDAQ is catching up. Seem to make perfect sense, so we're going to see the NASDAQ take off over the next few months. The problem, though, again, and this gets into that thing where I get conflicting signals out there, is that's not usually how it works. If you're coming off of a bottom, usually the NASDAQ is leading the way. And why? Because usually there's speculation into those small cap, or either in the small caps or the big cap tech. Usually there's more growth in those companies, and so usually that's where the big institutional traders are going to chase that growth if they're pretty confident that the market is bottomed. Well, that's not the case here. The Dow is leading. Now, again, this gets back to, could it happen this time where the Dow leads us out of the bear market? It could be. I'm not saying the NASDAQ has led everything. There are times where it doesn't lead, but again, it's one of those things that makes me cautious on the market breaking out. So that's something to keep an eye on too. Is these continue to see the NASDAQ outperform, and the Russell 2000 small caps. They tend to be leadership. And they're picking up a little bit lately. In fact, if we look at the 6-month chart here, we can see that the Russell 2000 is breaking out here today. It can hold that. It can close at those highs there. It'll have a nice little breakout there. You got this little V-shaped move. That's a pretty bullish looking pattern there. All right, bonds. This is concerned me a little bit too that bonds should be going higher as the market is going higher, as those bond yields are coming down. Now, again, we talked about this being critical and this being critical right here because we didn't have much of a corrective movement here, kind of impulsive up, impulsive down, kind of a impulsive move up right here. But now we're looking more corrective, more sideways. So whenever you see the market moving sideways or stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways, which was up right here. So I would assume that the bonds are going to continue to move higher and break out above this area right here. Not to mention that typically, if you look at about a 50% retracement of that move down right there, usually you're not going to retrace that much more than 50%. It's almost retraced entire, 100% all the way up to here. So if it was moving lower, you wouldn't expect that big of a move up in that context. But remember what we just got done showing you on the S&P chart. Remember when it was moving sideways and it had that December move down? It was more likely to continue to move down. It didn't. It didn't work that time. And so I don't want you to get so focused on this pattern that you believe it's always going to work. Sometimes the market will do the lower probability move, and it has to, because if that pattern always worked, we'd never be wrong. And we wouldn't have a marketplace, right? The reason why the market works is that it always will at some point throw people off, and usually it'll shake out the undisciplined traders and the people that are expecting to know or think that they know exactly what the market's going to do, and so they risk too much. They refuse to ignore signals that they're wrong. They don't want to be wrong, and those types of behaviors usually get crushed when the market makes some of these lower probability moves. So the higher probability is the way that the bonds are behaving. We should get a move higher off of this. But if it does start to drop, then we want to pay attention to that low. This high and this low. If we drop below here, that could be a much bigger decline in bonds. Bonds might be still moving lower at that point. But as of right now, I would lean more towards the bonds acting like they want to go up. Gold. I'd love the gold trade. Now, this is what I was talking about just a couple weeks ago. Gold had made this big move up right here, and it had moved into the extreme reversal risk and kind of the right side of that extreme reversal risk. What does that tell you? It tells you that trend is stretched. Now, I said it could pull back, but what it could also do is move sideways to alleviate that extreme condition. And over the last couple of weeks, gold has moved a little bit sideways, and that's brought that indicator back down off of that extreme range. And so although that trend does look a little bit stretched, it could continue to run from here. And I'm still pretty bullish on gold. In fact, I'm going to jump back into the GDX today. I told you because I got out of it when it was at the far right side of that extreme reversal risk range, and because I thought it could pull back a little bit, and it did. But I want to jump back in it again. Now, commodities sometimes, especially gold and silver, can stay extremely overbought for a while. They can get stretched and stay stretched for a while, and so it wouldn't surprise me if gold continues to rally here. Also, wouldn't surprise me if it does pull back. That move is a pretty sharp move right here. All right. So the trend, I expect gold to continue higher. Now, oil, the area on oil we were watching was this high right here. We did move a little bit above it. And then we started to kind of move sideways through here. Again, this move was up. The last couple trading days last week and Monday, yesterday, we dropped a little bit. We pulled back a little bit. Today's a little bit of a bullish, maybe a bullish engulfing pattern. Now, sometimes off of these sideways moves, I told you, whenever you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. When you have a longer sideways move, and I'm not saying this is overly long, but when it really looks sideways, it looks like it's in a tight range. First of all, that price action is reflecting indecision. Okay, buyers don't know if it's going to go higher. Sellers aren't convinced it's going to go lower, and nobody is showing a strong. They're not aggressively buying or aggressively selling. It's just kind of sitting there. Okay. Now, ultimately, usually off that pattern, you're going to go higher because typically when it's moving sideways, it's going to follow what direction it's moving in before it moves sideways. But a lot of times off of this pattern, I've seen this happen so many times over the years that it's something that I always kind of look for. Sometimes you could stay in the sideways range for a while, and you need something to kind of trigger it to get out of that range. And what can happen sometimes off these is that the buyers just aren't ready to buy yet or be aggressively buy yet because it's not cheap enough. They're looking. Have you ever done this before, where you're trying to buy something out there, but you know what you want to spend? Maybe a company had a sale on it 2 years ago, and you got this price, and you love the price you got for that product, and right now the price is too high. You want that same price, that same sell. You're waiting for that sell price again. And so you're not buying it until you get it, and then suddenly you get it, and you're an aggressive buyer now. You're going to buy 3 of them because you've been waiting so long for that sale, so to speak. Well, kind of the same concept can happen in this context here. We have these sideways moves. Is you'll get a little bit of a drop, and then that is what the buyers are waiting for, and then it comes right back up again, and then it breaks out. And so I don't know if that's happening here, but it wouldn't be shocking if you look at Friday's move. It brought it just down to the low part of that range, and then what happened yesterday? We got the drop below the range, and then immediately we're seeing kind of a bullish engulfing pattern right here. Again, it may not close like that, so I'm not going to call that a bullish engulfing. What I mean by engulfing is that you look at the body of the candle from the day before. It opened up here, it closed down here. And then the body today shows a complete reversal. It opened down here, opened lower than where it closed the day before. And as of right now, if it closed right here, it would close higher than where it opened the day before. And so it shows that reversal of sellers to buyers. At the open, the buyers were ready to buy, and they pushed it all the way up. And again, if it closes right here, they would close it higher than where it opened the day before. It's called a bullish engulfing formation. The stronger the formation is when you see a drop, a distinct drop ahead of that formation. This wasn't a huge drop, but a couple days there we've dropped, and we'll see if it reverses back up. If it can break out above there, that'd be very bullish for oil, and we'd expect oil to keep going higher. Now, again, that might be bearish for the market if oil starts taking off. Excuse me, because it's another inflationary type condition for the consumer out there. And then you have a higher low right here. This low is going to be important. If oil comes all the way down and drops below that low, you had a higher low, but then it went right back to a lower low. That'd be more bearish for oil. Now, oil's been in a sideways range for a while. Let's go to 1-year chart here. So it's not really showing any sharp directional movement. Every time it looks like it's going into an uptrend, it reverses back down. So this is one that, and now keep in mind, this is the commodity oil. There's a lot of oil stocks that have been in strong trends and done very well. And with oil at these prices, these oil companies are going to continue to make good money as long as it stays in this range. So you can find oil stocks that have much stronger trends than the commodity oil, but they tend to follow when oil tends to go up. Those companies tend to go up as well. So, and that's why we keep an eye on. And oil has been one of the leading sectors for a long time on our sector list, outperforming for the last year. The dollar continues to look like a downtrend. It has been moving sideways the last couple weeks, but again, the previous move was down, so we would expect that the dollar would continue to move lower. That's still bullish for oil and gold commodities. The dollar drops, there's a relationship there. The VIX, again, this is one of those conflicting signals that keeps bugging me. Is it's hard for me to believe the markets can have a sustained big rally with the VIX down below 20. We keep coming up to 20 and then coming back down. I don't need to even be in the fear range up at 30. I mean, just a VIX up around 24 or 25 would give me a lot more confidence in the upward, in the current upward move in the market. But this is something that really concerns me. This is looking like a real shock to the downside is about to happen, or at least the market's in danger of that. And that's, as long as I continue to see that, I may add some things to portfolio, but I'm going to be pretty cautious. In fact, I'm going to do something today that is going to hedge me a little bit. Actually, I did it yesterday, but it hedges me a little bit in the portfolio there. All right. So that's something to keep an eye on. Chip stocks. Now, some of them have earnings coming up. AMD, I don't know if AMD is this week or next week. But a lot of them have still done pretty well. It broke out, as you can see, it broke out to a higher high right there. So it is starting to lead the NASDAQ 100 a little bit. Remember, the NASDAQ 100 is just barely broke out of that high. This is a little bit stronger breakout right here. So you're seeing a little bit of that leadership with the chip stocks right now, compared to NASDAQ 100. Transportation stocks, you're kind of comparing this to the Dow. What I like about this chart is, the Dow looked like it was losing a little bit of steam, but the transportation, this is a pretty strong bullish pattern. You got a little bit of a cup with handle formation right here. Now, if we break out, the key is going to be the breakout. If it breaks out above that formation, you can take the top of the bowl, the bottom of the bowl, and project that upward. And that could signal a pretty strong bullish run on the Dow. Again, you're comparing the transports to the Dow Industrials, which is called the Dow theory. If you want to Google that and learn a little bit more about the Dow theory, you can do that. And the reason why I say that is because there's probably stuff you find I don't get obsessed with this stuff. I do look at it. I am aware of that relationship, and I include it into the market update. But I'm not obsessed with it. But if you go Google it, you'll probably find better explanations than I can give you on what the Dow theory is. And there's a lot of people nowadays that don't believe as much in it, and I don't put as strong a correlation on it as some might. But that's why I use the NASDAQ 100 and the chip stocks as well, because I think both of those together can give you a pretty good idea. The chip stocks tend to lead the tech industry. How the chip stocks do, their charts tend to lead the way, lead up and lead down. And the transportation stocks tend to lead the Dow Industrials. And so when you get both of those pointing to the market going up or markets going down, it can be very helpful. But I don't ignore it. Some people ignore it now and say it has no relevance, but I don't see how that's true, because it just makes sense that the way we transport stocks or transport products has changed over the years. Well, not much, but I mean, we do a lot more air shipments than we did in the 1920s or whatever. But it's still, if they're moving more products, it usually tells you the economy's good. If it's moving less products, it usually tells you the economy's slowing down or not doing as well. And so it still is a pretty reliable indicator, in my opinion. Bitcoin's had a run. It seems to be kind of consolidating a little bit. I wouldn't be surprised if it pulls back a little bit or continues to move sideways and consolidate that move. But we talked about this possibly being in a trend reversal. Had all the signs of a bottom. Panic selling. Nobody wants to own it. People are afraid to buy it. That kind of stuff that we're still waiting to see in the markets. But we'll see. That one of the key things is going to be how, does this hold up right here? It can pull back a little bit. You don't want to see it come all the way back down to these lows again. If it can look more choppy and sideways through here on the pullback, it has a good chance to continue to move higher. That's always the trick: is are you at the bottom, or are you is it just a bear market rally? That's why it's so difficult to pick a bottom. There's a question on the HYG. Yeah, I haven't been looking at it. I was going to actually bring it up today. I took it off the list just because I told you we weren't going to be. The market was focused on that during a period of time, and then it stopped being kind of focused on that. But there is something that happened yesterday that it caused me to pay attention a little bit. This is the high yield corporate bonds. Is these have gone higher, the market has kind of gone higher. What I noticed yesterday, though, is that recently the market has gone higher, but the high yield corporate bonds had kind of a little bit of a lower high, and then we dropped a little bit to a lower low right here. Now, with the move up today, you could probably make the argument this is maybe a bullish ABC pattern, and this is very similar to the TLT. Is it gonna go higher? Is it gonna come down and go lower? Both these levels are going to be pretty important. Obviously, it kind of went up a little bit higher than that previous high right here recently, only to kind of pull back from that. Like I said, the market has gone higher with high yield corporate bonds not confirming that. Now that could change, but this is something, I'm watching, keeping an eye on it. If you start to see this slide, and not follow the market moving higher, it could be a divergence that could indicate a market pullback. But yeah, that's something we're kind of keeping an eye on there as well. All right. In the portfolio, I added a few trades last Thursday. They've done prettle well. Newmont has pulled back a little bit recently. This is one of our gold stocks here. A little bit of it's actually acting now. It was a little bit of a bullish reversal candle, but now it's actually an indecision candle if it were to close like that. But like I said, I still like the trend of gold. I think gold could continue to move higher, and I have a really wide stop on this. I'm giving it some room just because I think it has a lot more upside. First Solar is one I added. Now, I was a little bit worried because on Thursday, I think I mentioned that I had a tight stop. I have a stop right below here, but one of the things I was worried about was that, and I can switch this over to signals too. Oops. Why is it not going to signals? This doesn't want to go to signals. Hopefully that's temporary. But I mentioned that it's still possible this could be wave A, wave B, and you get a wave C. It comes down here a little bit, and that might stop me out. and we had this down candle yesterday, so I was a little bit worried that maybe that was starting wave C. Kind of back up again today. That's still possible though. I mean, this is kind of choppy through here. It could have one more move down and then go higher. I had those tight stops just because of all the uncertainty this week. I don't want to risk too much. Schlumberger, another oil stock. So one was kind of the solar sector within energy. This is obviously oil services, and I like this pattern. And this kind of correction through here broke out, kind of retested the breakout, started to move back up. It's been a little bit flat since we got in, but again, and this one I had a pretty tight stop as well. I think I was down below that breakout. And then FMC, this one actually has done pretty well. Had a little bit of a bearish candle yesterday. A lot of them had bearish candles yesterday, but it's kind of back up today, acting like an uptrend right here. It can break out above here. It could take off. If not, I've got a tight stop. And then I added, because I wanted to hedge a little bit with those positions, what I'll do sometimes is hedge with these inverse ETFs. This is a opposite of the ARK Innovation Fund. That's Kathy Wood's fund, and she's in a ARKK as a ticker symbol. She's in a lot of really speculative stocks, Zoom video. She's got all the stuff that she got into during the pandemic that she thinks is new technology that's going to take over the world and become the next Amazon and Google and what have you. And ultimately she might be right on some of these, but the problem is that as everything crashed down and came down, she kept just digging in and saying, I know this is going to work, this is going to work, this is going to work. And you can look at her fund, it's got destroyed, from its peak, just refusing to, admit that you're wrong. I mean, that's the downfall of every investor that gets too big in the head, that's more focused on being right than making money, is that they'll dig in and they'll write it all the way down. What does she keep saying? I'm eventually going to be right. You're going to see eventually going to be right. And maybe 10 years from now she might, but but she's going to be broke, or it's going to take her 10 more years before she makes money. In the meantime, she's probably going to make a killing shorting her stocks that she was in when they stopped acting like they were going up. So it's a good lesson to check your ego at the door, or it'll kill you in trading. So what I've done is, obviously this stock is actually rallied in January off those lows. Again, it's got she got big holdings in Tesla as well. And so yesterday I was looking at Tesla, and Tesla had a little bit of a bearish candle, kind of a bearish inside day. Again, this is not suggesting that Tesla has to go down, but usually on a bearish inside day, you'll get some sort of a downward move after that. I didn't want to trade Tesla itself because it tends to be, there are people that buy, it's kind of like Apple. People buy Tesla, they don't care about the fundamentals or anything, they just love the cars or whatever. So there's some irrational reasons why people will continue to buy the stock and prevent it from dropping sometimes. So, but what I did is I looked at the inverse of that ARK Innovation Fund, and it actually had a bullish inside day candle yesterday. Now it's back down a little bit today, but my rationalization for this trade is that this is acting like it wants to rally a little bit, meaning that ARKK, Kathy Wood's fund, should pull back a little bit, my expectation. And if it does so this is lined up to where you probably, if the market drops this week, this will go up, and that'll hedge those other trades that could go down. We could see FMC go down or SLB go down or FSLR drop or something like that, or gold, and that would kind of hedge that a little bit. So that makes me a little more comfortable having those multiple positions. Now, we were kind of mildly bullish with kind of the market analysis we did today. I wasn't going to add anything, but I was looking under well, first of all, I was looking under the new buy list. There's one in there that there's only a couple that are in the 90 strength rank. You really don't want to dip below the 90 strength rank. This PFGC was one that I thought I could at least highlight today. A little bit of a bowl-shaped move here, especially if you can break out. You might want to just see if you can break out with everything that's going on this week. Does it rally and break out of that? Could have room to run. But then I also was going through some of the sectors. Now I'll do more of this on Thursday. Like I said, I wasn't planning on adding anything, but under computer and technology, I came across this SGML 99 strength rank. And what I really liked about this chart is it has almost the perfect setup that I love to see for a bullish trade. You've got this longer term uptrend. You have what looks like a larger ABC correction. And you have a smaller impulsive move up off of that. And then you have this consolidation, this correction. So this is a smaller move up, smaller correction out of a larger move up, larger correction. Now, this is a pattern that Jesse likes as well. Anyone that's traded ABC patterns and Elliott wave and things like that, it's a very good pattern to trade. It just means you have a larger uptrend with a larger looks like it's coming out of a larger correction, and then in the short term, you're getting confirmation of that with a smaller move up, with usually a smaller ABC correction, although this is more sideways than an ABC right here. So you have this larger ABC, larger trend, and then you've got the smaller move up, the smaller we'll use the lowercase ABC. And so there's a pretty high probability that this is at least going to get back up to here, if not break out higher. Now, again, doesn't mean it will. And there are plenty of times where this pattern ends up not working, but you don't get it very often, or you have to really be patient, wait for it to form. And so when I saw that, I'm like, this is great. So I'm going to enter this, and I'm going to put a stop down below here. Because if this is that larger ABC and this looks like it was starting to move up and it comes back down and goes lower, I don't know what it's doing now, and that's where I know I'm probably wrong. So I'm going to put my stop in right at about 25, which is actually right at that low. And I got to hurry here. We're running late, but let's add this in. We could probably do about, let's do 275, 270. That's about right, 270. Let's check our portfolio at risk. We don't want it to be more than 1.5%. It's right at 1%. Now, if I do get stopped out, I'm going to lose $1,500. You better be okay with that dollar amount. I'm fine with it, but if that's too high, then you might want to either have a tighter stop or buy fewer shares. I'm going to go ahead and purchase that. And then I wanted to add the GDX back in. And where was I putting this? I was going to put the stop just down. I was going to put it down here. We can move it up, but I want to give it a little bit of room again. I might buy fewer shares on this one just to, I don't know if I want to have that much capital in, but let's see what we are at here. I'm going to do 220 shares, about 7,000. So a little bit on the lower and a little bit on the lower end there of the amount of capital in. And I'm below 1% portfolio risk, so that'll work. Let me see what my allocation is. Okay, I don't have more than 50%. That's still, for this condition, that's still probably a little bit too much in maybe. But I'm hedged a little bit with that SARK, so that makes me feel a little bit better. And I can add to it. If we start to drop tomorrow with the Fed and everything, I can add in that SOXS or some of those other inverse ETFs to hedge our positions a little bit. All right. That's all I have. If you have any questions I didn't get to, make sure you email those to me. I'll be happy to answer those for you. Have a great week. We'll see you Thursday for the stock specific class. Bye now.